Today, I'm going to be breaking down the history of the 30-year mortgage and how the US government accidentally created it during the Great Depression. Then I'm going to tie it back to what's happening today in the market. So let's go over the history of the mortgage program so you get a better sense of where we are today and how we got here. So most people just accept that the 30-year mortgage is like gravity. It's just there. You buy a house, you get a 30-year loan, you pay it off slowly, and that's just how it works. But here's the thing. It was invented by the United States government during one of the worst financial disasters in American history. And before it existed, buying a home in America looked nothing like what it looks like today. And understanding how we got here actually explains a lot about why the housing market feels so broken right now. So let's rewind a little bit. We're talking about pre-1930s America. Let's say you wanted to buy a house then. You had to go to your local bank, you asked for a loan, and if you were lucky enough to get one, which a lot of people weren't, here's what you actually got. You got a short-term loan, like 5 years short, and you didn't pay it down over time. You simply just paid interest every single month. Then, at the end of 5 years, the whole amount came due at once. So you'd either pay it all back in cash, refinance it into a brand new loan, or lose the house. Most people just kept refinancing and hoped the bank would keep saying yes. Oh, and down payments? Today we've got 0, 1, 3, 5% down payments. Back then, you had to pay 40 to 50% upfront before the bank would even talk to you. So homeownership was basically only accessible to people who were already doing pretty well. Homeownership rates sat around 45% at this time. Then 1929 happened. The stock market crashes. Banks start failing across the country. And when a bank got into trouble, one of the first things they'd do is call in their loans. They'd say, pay us back right now. And most people couldn't. Most people didn't have that kind of cash sitting around, especially during a depression. So this caused foreclosures to explode. At the peak of the Great Depression, roughly 1,000 homes per day were being foreclosed on in the United States. 1,000 homes every single day. By 1933, half of all mortgages in the country were defaulted. Half. The whole system was broken, and the government knew it had to act. At this time, Franklin Roosevelt came in with the New Deal. In 1933, Congress created the Homeowners Loan Corporation. Most people have never heard of this, and I bet you didn't know it either. But it might be one of the most important housing programs in American history. See, it stepped in and bought up distressed mortgages directly from failing banks, then replaced them with something completely new. They replaced these short-term loans with longer-term loans, fixed-rate interest rates, and payments that actually pay down the balance every single month. See, for the first time, a homeowner could know exactly what they owed, exactly when they'd be done, and know the bank couldn't show up in 5 years and demand it all to be paid back at once. The HOLC refinanced over 1 million mortgages in 3 years, and it kept more than 1 million families in their homes. Then, in 1934, the Federal Housing Administration was created. The FHA didn't lend money directly, but what it did was insure mortgages. If a bank made you a loan and you couldn't pay it back, the FHA would cover the loss. See, this protected the banks. And because the bank was protected, banks were suddenly willing to do things they'd never done before. They were willing to do loans that lasted 20, 25, 30 years with down payments as low as 10 or 20%, fixed rates that never changed, and every payment actually lowered what you owed. You paid down the principal. At the end of 30 years, the house was yours. No balloon payment, no surprises. This was a completely different relationship between a person and their home than had ever existed in America before. And it worked. Homeownership rates started climbing. But here's the part that usually gets left out of this story. See, the FHA used a system called redlining. Government officials would literally draw red lines on maps around neighborhoods that were predominantly Black or immigrant communities and mark them as too risky to insure. And that meant banks wouldn't make loans there. Meanwhile, new suburbs were being built for white families with deed restrictions that literally prevented the homes from being sold to Black families. And in those neighborhoods, the FHA insured mortgages there all day long. So the 30-year fixed mortgage as a wealth building tool as the foundation of the American middle class, it was deliberately made available to some people and deliberately withheld from others. That decision made in the 1930s and 40s still echoes through homeownership today, the gap between white and black families. So let's jump to when World War II ends. Millions of soldiers came home. The GI Bill passes in 1944. Veterans could get mortgages with zero down payment. Zero. And this sets off the single biggest homeownership boom in the American history. Suburbs explode. The 30-year fixed mortgage becomes the default way that Americans buy homes. But a problem starts to develop. Banks can only lend out so much money. Once they've lent out all of their deposits, they're stuck. And this is where Fannie Mae becomes essential. Fannie Mae buys mortgages from banks. The bank makes you a loan. Fannie Mae buys that loan immediately. The bank gets its money back, and now it can go make another loan, and another, and another. This created what's called as a secondary mortgage market. It meant the supply of mortgage money was no longer limited by how much any one bank had sitting in deposits. And that helped millions more people buy homes. But it also meant there was now always a massive river of money flowing into housing, which is part of why home prices trend upward from that point. That tension between making homeownership accessible and prices rising because so much money is chasing homes, that's a tension we're still living with today. Now, here's the part that most people have never heard. There was a period of time where the 30-year fixed mortgage almost disappeared entirely. The 1970s brought massive inflation, and by the early 80s, mortgage rates hit 18%. Think about what that means for a second. If you bought a $100,000 home at 18% on a 30-year mortgage, your mortgage payment would be around $1,500 a month. And over 30 years, you'd pay nearly $500,000 total for a $100,000 house. Almost nobody could afford to do that. And so the housing market basically froze. And here's where it gets really interesting. The problem wasn't just that buyers couldn't afford homes. The problem was that banks themselves were getting destroyed from the inside. Now let me expand on that. Banks had made tons of 30-year loans back in the 50s and 60s at a rate of like 5 or 6%. Those loans were sitting on their books, slowly paying back at 5%. Meanwhile, now in the 1980s, new loans could earn 18%. But to keep depositors from pulling their money out and putting it somewhere better, banks had to offer competitive rates on savings accounts too. So they were paying out 10, 11, 12% to people keeping money in the bank, but they were only collecting 5% on all of those old mortgages they'd made decades ago. And that gap, paying out more than you're bringing in, is called an interest rate mismatch. And that is absolutely fatal for a bank. Hundreds of savings and loan banks collapsed. It became a full-blown financial crisis called the savings and loan crisis. This cost taxpayers around $130 billion to clean up. After this, a lot of economists and banking experts said the 30-year fixed mortgage was just too dangerous, and that banks were absorbing all of this interest rate risk by locking in long fixed rate loans, and it was going to keep blowing up. Some countries looked at this and moved to adjustable rate mortgages as the default, where the rate changes with the market and the risk sits with the borrower and not the bank. The UK did this, Australia did this, and most of Europe did this. But America kept the 30-year fixed mortgage, partly because voters loved the stability of knowing your payment will never change, and partly because smart people figured out a solution that let banks offer the 30-year fixed mortgage without actually holding the risk themselves. Which leads to the most important thing most homeowners don't understand about their own mortgage. And this is why your mortgage gets sold. So if you've ever gotten a letter in the mail saying your mortgage is being transferred to a new company, maybe you signed with one lender and a few months later, you're suddenly sending payments to someone completely different. And here's exactly what happened and why. After the savings and loan crisis, the mortgage market restructured around a system called mortgage-backed securities. Here's how that worked. A bank or lender makes you a mortgage. Almost immediately, sometimes within weeks, they sell that mortgage to Fannie Mae or to Freddie Mac. Fannie and Freddie then bundle up thousands of mortgages just like yours together. We're talking thousands of homeowners, different states, different loan amounts, all pooled into one giant bundle. Then they sell shares of that bundle to investors, like pension funds, insurance companies, foreign governments, hedge funds, anyone looking for a relatively safe and steady return. You keep making your monthly payment, that payment flows through the bundle and gets distributed out to all of those investors. The original bank that gave you your loan, they got paid the day they sold it to Fannie or Freddie. They've moved on. Now here's why this matters so much. Remember the savings and loan crisis? The whole problem was that banks were stuck holding the 30-year fixed rate loan on their books for decades. So when interest rates changed, the banks got crushed. The mortgage-backed securities system solves that problem. The bank makes the loan and sells it almost immediately, collecting a fee and moving on to make the next loan. The interest rate risk gets spread across thousands of global investors instead of sitting on one bank's books. That's the trade, and that's why the system exists. And it mostly works until the people deciding who qualify for a mortgage start getting a little too loose with standards, which is exactly what happened in the early 2000s. The mortgage-backed security system had been working fine as long as mortgages inside the bundles were being paid back. But in the early 2000s, something started to shift. Home prices were rising fast, and lenders figured out that if prices kept going up, almost any loan would eventually work out. If someone couldn't pay, you'd just foreclose and sell the house for more than the loan. So lending standards started to slip, and a lot of these new loans weren't even 30-year fixed mortgages. They were adjustable rate mortgages with what's called a teaser rate. Here's how a teaser rate works. You get a really low rate for the first 2 or 3 years. Like artificially low enough that people who couldn't really afford the house could just barely make the payment. And then the rate resets way higher. Suddenly your payment goes from $1,200 a month to $1,700 or $1,800 per month. And a lot of people couldn't handle that jump. Now here's where it completely falls apart. They'd been told by lenders, don't worry about the reset, you can just refinance before it happens. But to refinance, you need equity in the home. You need the house to be worth more than you owe. When home prices stopped rising in 2006 and 2007, and started to fall, millions of people were suddenly stuck. They couldn't afford the reset payment. They couldn't refinance because the house was worth less, and they couldn't sell because they owed more than it was worth. So they had to stop paying. And when enough people stopped paying, the mortgage-backed securities built on top of those loans started to collapse. And because those securities had been sold to banks and investors all over the world, the damage spread everywhere instantly. It wasn't just an American problem. It was a global financial crisis. 8 million people lost their jobs. Around 4 million families lost their homes. And Fannie Mae and Freddie Mac, which had been sitting at the center of all of this, buying up mortgages and packaging them, had to be taken over by the government in an emergency weekend bailout in September of 2008. They are technically still under the government control today, over 15 years later. The government has never figured out what to do with them long term, and that unresolved situation is quietly one of the more interesting tensions in the mortgage market right now. So here we are, after the Great Depression, the New Deal, the post-war boom, the savings and loan crisis, and 2008. We still have the 30-year fixed rate mortgage. It survived all of it. Today, about 70% of all mortgages in America are ultimately backed by taxpayers through Fannie, Freddie, and the FHA. Most people have no idea the government is that deeply involved in their mortgage. And here's the thing about the 30-year fixed-rate mortgage that really matters for what's happening right now. It is an incredibly borrower-friendly product. You lock in a rate. If rates go up, you keep your low rate. If rates go down, you can refinance. The upside is all yours. The downside belongs to the investor. And that is why when rates jumped from 3% to 7% between 2022 and 2023, millions of existing homeowners just didn't move. They had rates so good that selling meant giving them up forever. That is a huge part of why housing inventory today is so low. The very product that was designed in 1933 to help people hold on to their homes has now created what we call a lock-in effect that's making it nearly impossible for new buyers to find anything to buy. The solution to the Great Depression became a contributor to the problem we have today. And that's how these things work. One crisis creates a fix. That fix creates the next crisis. So the 30-year fixed rate mortgage was invented to stop people from losing their homes. And that definitely worked. It built the American middle class. It turned the suburbs into what they are today. It's created generational wealth for tens of millions of families. It also also excluded people along the racial lines in ways we're still dealing with today. It caused financial crises of its own, and right now it's part of the reason the market is so locked up. It's one of the most consequential financial products ever created, and most people who have one have no idea where it came from. But now you know. Don't forget to like, subscribe, and comment down below.